As a long-term investor, you may hold mutual funds or perhaps you have a few stocks. Maybe you have a 401k or a self-directed retirement account, and this is how you've been building wealth for your retirement through the stock market. You may have been taught that buy and hold investing was the best way for you to accumulate wealth through the markets. Perhaps you don't pay much attention to what's happening with your investing, or you haven't been in a position where you felt like you wanted to make a lot of decisions that could help you to reallocate your assets and get better results than you're getting right now. With the market forecast, we're going to teach you first how to protect yourself against taking big losses in your accounts so that you can accumulate more wealth over the long term. And the second thing we'll do is help you to understand when it's time to be in the stock market. With the forecast graph, we'll simply focus in on two simple lines. The first line that we'll look at is our long-term line. The second line that we'll evaluate is our intermediate-term line. When these lines are moving up, the trend of the market is up, and when these lines move down, the trend of the market is down. It's very simple. We want to be in the market when it's trending up, and we want to protect ourselves when the market is trending down. In the summer and the early fall of 2007, we saw that the long-term line was very clearly trending up, had been for some time, and the intermediate-term line was trending up also. With both lines trending up, the market trend was up. It was a great time to be in mutual funds. It was a great time to be in stocks, especially large cap quality stocks that followed the market. As a result, many people were making money. The market topped out. It reached an all-time high in October of 2007 at over 14,000 points on the Dow Jones Industrial Average. However, you'll notice that both of these lines were high up in the chart. As the chart becomes darker, that's what we call a reversal zone. And whenever the lines reach a reversal zone, that tells us at some point in the near future a reversal is about to take place. The market trend is going to change. Well, what happened here was by the second week of October, the intermediate line had turned sharply. It was moving down, and the long-term line was moving down as well. This indicates to us that the market trend is no longer up. The market trend, in fact, is starting to turn, and it's going down. So how do we protect ourselves when the market starts to go down like this? We simply look at the forecast graph. You don't have to day trade, and you don't have to be a very active investor in order to get better results. You simply log in, look at the forecast graph, do this regularly, and when you see the market trend is changing, protect yourself. For a mutual fund investor, this was a great time to go to cash. Very easy to go to cash in a mutual fund. Just contact your 401k fund administrator, contact the mutual fund company where you've bought your shares, or talk to your broker, either discount or full service broker if you're using a broker. Tell them it's time to reallocate. It's time to stop being fully invested and go to cash. You can do this by going to the money market component of a mutual fund family. You don't have to close down your 401k. You don't have to close out your SEP or your other self-directed IRA. Now, this is important because in October of 2007, the market reached an all-time high. It traded up over 14,000 points on the Dow. Within the next 18 months, the market had plummeted. It lost 55% of its value and traded down to about 6,500 by the middle of March in 2009. The market was down 55%. Now, you may be saying, yeah, but I'm not in the market. I was investing in a mutual fund, and the mutual fund manager is getting paid to protect me in a down market. I'm sorry, but they can't protect you. In fact, studies of over time have proved that mutual fund managers typically don't do quite as well as the market when the market's up or when the market's down. Some of the best-known mutual fund companies out there had the same results. Vanguard, in their large-cap flagship fund, when the market was down 55%, that fund was down 58%. And Fidelity, another very well-respected mutual fund company, their large-cap fund, the market was down 55%, their fund was down 61%. In fact, it's alarming how closely these funds tracked the market as it moved down. While the market was down 55%, these funds, the chart on these funds looked almost exactly the same, and they were down even more than 55% over the same time frame. In fact, between October of 2007 and the end of November in 2008, investors worldwide had losses of more than $21 trillion. This is why you must understand when trends are changing and learn to protect yourself and not take big losses. So, what do we do to take advantage of the market when it moves back up? Log into the forecast, look at the forecast graph regularly, and be patient. Let's say you're in cash. How do you know when it's time to be back in the market? By March, 1st of March, late February of 2009, the forecast graph showed us this. The long-term line had come very far down into the lower reversal zone at the bottom of the graph. The intermediate line had also come very far down into that same lower reversal zone. And when you see this happening, it's an indication that a change of direction is imminent. And market bottoms are generally very powerful and clearly indicated. By the first part of March, you see that the long-term line has started to move back up. The intermediate line by the middle to the end of March has moved up sharply and is moving up very nicely. And this tells us the trend is no longer down. The trend had been down more or less since October of 2007. And now by the first part of spring of 2009, the trend has changed and started to move back up. It's time to get back in and take advantage of market movements. Now think about this. At the end of the winter, first part of spring, most investors in the markets today were terrified. They didn't have information like this to tell them that the market trend had changed. The market went from a low of 6,500 points in the first 10 days of March, and by the end of the summer, the market was trading up. In fact, it topped 9,500 points on the Dow Jones Industrial Average. That's a gain of about 50%. Now you'll notice even though the market was back up about 50%, it still had not reached anywhere close to its all-time highs. This is why it's very important to protect yourself in a downtrend and learn to take advantage when markets are trending up. Mutual funds were back up. The Vanguard fund retraced part of its losses, and whereas it had been down about 58%, it bounced back up some and had a move up of about 48%. The same Fidelity fund that we showed you earlier, it was down 61% during the bear market, and over the summer it came back up and regained some of its losses. And this is how investors have learned to protect themselves and then take advantage when the markets turn and go back up. What we want to do at the Market Forecast is teach you to avoid high-risk investing. High-risk investing is remaining fully invested and exposed to the market when the market is trending down. From its 2007 highs, the Dow Jones Industrials are down, even today, about 30% from over 14,000. Well, most mutual funds are down even more. In fact, a typical $100,000 portfolio in mutual funds, whether it's a retirement account or held in a taxable account, that portfolio today is only worth about $60,000. What we want to do is teach you how to use the market forecast method so that you can protect yourself. In other words, when it's time to go to cash, go to cash. You could have kept that $100,000 portfolio intact by simply going to cash when the market trend changed back in October of 2007. You only get back into the market when it's safe to do so, as indicated by the forecast graph. And so far this year, from the market bottom, the market is up about 40%, and your mutual fund investments could have been up about 40% as well. What this means is that with a low-risk approach that we teach, the account balance for your investments could have been up to more than $140,000 this year. In other words, you protected yourself in October, December of 2007, and then you took advantage of the opportunity to get back in the markets as the market trend changed and moved back up. That's a difference of more than $80,000. This is how we learn to invest properly. This is how we learn to protect ourselves, because markets don't always move up, they move down. And by understanding that once, twice a year, not frequently, but when it's appropriate, we reallocate our assets and we take advantage of the trends in the market today using the market forecast.